Hi, how are you? Justin Brennan here with the Brennan Pohle Capital Group. Welcome into a smarter way to invest in real estate. This fund was built for investors like you. They want choice, control over your risk, access to the deals that align with your core values and unique goals. And through our customizable fund structure, you get to decide where your money goes and in which deals it goes to. Do you prefer quick gains from residential flips? Great, we have that. Do you want long-term cash flow, massive tax benefits from the multifamily side of it? We got that as well. Do you want both combined? You're in full control. We got that. Our hybrid strategy of investing combines fast profit cycles of flips in our model in San Diego, California, with stable cash flow, equity growth, and bonus depreciation of advantages of apartment buildings throughout the United States. But what really sets this apart and us apart is the liquidity factor. Unlike traditional syndications, this fund gives you the access to your money. So after 18 months of seasoning, simply give us a 90-day notice and request your redemption, your money out. No lockup periods for 5+ years, no waiting until the property sells, any of that stuff. You're investing with flexibility, speed, confidence, all while leveraging the powerful tools to reduce or even eliminate your taxable income. So what I'd like to do for the next few minutes is I'm going to go through the slide deck on the fund and show you exactly what it does, give you some examples on deals and case studies, and let you take a look at this thing and see if this is the right tool for you to invest in real estate alongside us. Okay, so this is our hybrid fund. Go through a little bit of the table of contents with you and that, but pretty straightforward. The offering summary, the market, the financials, how to invest, our operational team and who we are and our background, and all of that stuff will be included here. Quick little summary on the fund. Powerful, customizable fund. You choose where your money goes. It has a hybrid investment strategy around flips and multifamily. Flips and multifamily. I'll get into the details here in a minute. The summary, I just kind of read to you about it, what the fund and how it was built and put together, specifically for folks that want choice, right? But you also want the benefits of having multiple choices inside of a fund, but being able to delegate where your money goes. Maybe to all of them, maybe to some of them. You get to dictate that. And then having redemption rights that, hey, if you need your money out for a life event, whatever may happen, you have that option through this fund. And we've set it up and designed it really for that. I mean, to be quite honest, I designed it for somebody like me, right? Where you want all these benefits of investing in real estate passively, but you also want some controls over where the money goes because you don't like maybe general blind pool funds or any of that stuff. And you then also want the benefits of having higher velocity returns, so that's where the flips come in and having a specific model for that. But then also the multifamily side of it, which is really the holy grail of cash flow, profits, appreciation, inflation hedges, and all the tax advantages that come with multifamily apartment buildings. So this is how we've set this up. You have fund allocation. Let's say we had, $10 million come into this. This is the $25 million fund, but this is showing you essentially how the money gets allocated. So 25% of the money is going to go into the flip model, right? And you get to dictate that, right? If your money comes in, that would go in there, but 25% would go into that, 75% into the multifamily. And this allows us to hedge, right? We're not getting overly risky with the flips because we all know better returns, a little bit more risk, but we've set up a model in San Diego around 80 ADUs in development, as well as with the flips, that allows us to turn that money faster and also have better returns, but also leveraging the risk environment. So you're not over leveraging, over speculating. It's a nice little model that works in Southern California and San Diego. And then you have the multifamily. We're going to get into where we invest, how we invest, and how that works. So it's a $50,000 minimum investment, 9 to 12% preferred returns, depending on how much you bring in. I'll show you that in a minute. You're getting 65% of the profit splits, right? And the cash flows that are coming out of the fund. 2 to 5 year investment with 90-day redemption rights. And we've talked about that. Season for 18 months and then 90-day notices, and you can get your money out. Targeted returns, right? Annual rate of returns, IRR of 18 to 24%. So you can see kind of with this hybrid strategy, we're able to increase the preferred return because of the higher velocity. Also delegate the risk correctly. So we're not like all the money going into flips. By no means. We want the money into safer investments like multifamily and apartments, cash flowing assets, but also be able to trigger that with some higher velocity returns around the flips. That's the benefit of it, but not over allocating. And then targeted returns, you're able to get higher returns on an annualized basis. So where you'd normally maybe seeing 14, 15%, maybe 16%, right? Now we can boost it up and get up north of 20% or more on your returns for you, but also leverage the risk correctly. Quarterly distributions. We're going to work to try and get to monthly distributions, but right now it's quarterly distributions, just for accounting purposes and making sure it runs smoothly. But we would love to get to the point of monthly distributions. I think that'd be great. Tax avoidance through bonus depreciation. So when your money comes in that calendar year, it'll be put into an asset that was acquired and closed in that same calendar year. So you get the bonus depreciation. Okay. Inflation hedge, and it's more liquid with the redemption rights. Here's kind of where we're investing and targeting. Flips in San Diego. So you see that. Okay. Stressed multifamily, right? And I don't say foreclosures or de-stressed or distressed multifamily, but stressed, because there's a lot of that in the marketplace right now where you had syndicators from a few years ago. They got deals and they can't get out of them, right? They're either over leveraged, bad debt, or bad operations, and they need to move on from it because they bought it at a bad time and they can't really hang on to them anymore, but they want to avoid foreclosure. So you can go in and sweep it up, wipe out their equity, take it over, maybe pay off the existing loan or take on the existing loan that's a good debt, and move that property because now you have a new basis. And that's kind of the stuff we're looking for in the multifamily space. Strong job growth and population stats, growth markets for all of that. Top 75 MSAs, those are metropolitan statistical areas in the United States. We target those. And risk mitigation. Showing you kind of the capital stack. $50,000 minimum investment. You can see the equity multiple projections of 2 or greater. Preferred returns depending on what you invest, whether you're bringing in 100K or under 100K. So this kind of shows you. So 9% under 100K, 12% over 100K. In terms of your preferred return, projected annual IRR, 18 to 24%, 2 to 5 year hold period on the investments, property types, multifamily and flips, redemption rights, 90 days. Let me get into the financial summary on it. So a total fund of $25 million. It's an evergreen fund that we're raising money into. It never closes out, so you can bring money in at any point in time. You get to delegate where the money goes based on our investments and our opportunities inside the funds. You'll get to see those, and you can dictate, hey, maybe I only want it into Texas. Maybe I only want it into SoCal. Maybe I want it into Arizona. So you'll be able to see the deals we have and delegate the funds into it. Preferred returns and everything, kind of showing you that over here. We kind of went through that already. Let me give you some investment examples. So that I'll give you a $50,000 investment example and then a $100,000 investment example. So looking through this, preferred return at $50,000 would be 9%. Quarterly distributions, projected returns 18% annually with a 65% profit split and cash flow split. It's 15% IRR up to 15% IRR, then it goes 50-50. So on that split, 65-35, right? 35 to us as the general partner and fund managers, 65% to you as an LP limited investor, passive investor. And then once you hit a 15 IRR, then it goes to a 50-50 split with projections around 18% or greater per year. Equity multiple at 1.9. And then this breaks down your cash flows. And I'll send this to you if they have this in front of you, but this will break down projections on the cash flow model, showing you what to expect in each of the years. Okay, so that's for a $50,000 investment. Total ARR, right? Annual rate of return. IRR is 18, annual rate of return of 23.5% with all the tax benefits and bonus depreciation. And this breaks it all down. So pretty cool. And using that hybrid model, that's how we're able to do it, right? I mean, we're able to allocate 25% of the money into the flips, right? We're moving that stuff faster. You're turning these things over in 4 to 6 months. So you're moving that, right? It's higher velocity of returns. Allows us to juice it, but not over allocate. And then a majority of the money into the multifamily, the safer stuff, where you get all the benefits of taxes, hedge, cash flow, and appreciation. So that's why that's all there. $100,000 or more. This is what that investment's going to look like. So preferred return of 12%, which is great. Distributions quarterly, 21% IRR projections on that. Same setup, 65% split to a 15 IRR, and then it's 50-50 after that. Equity multiple of over 2. This breaks down all the cash flows. You can take a look at this when you open up the pitch deck. 25% ARR, annual rate of return, with all the tax benefits of bonus depreciation to wipe out your income taxes in that calendar year. So we have a lot of people come to us and they say, hey, I'm going to have to pay Uncle Sam $100,000 this year. So I have two options. I can pay Uncle Sam, or I can stick it into your fund or into an investment, get almost a dollar for dollar write-off on that in the same calendar year. So if it's this year and you're trying to write off X amount of dollars, you need to invest this year. We're going to put it into a deal acquired this year. So that way we will bonus depreciate you almost a dollar for dollar to wipe out that income tax to Uncle Sam, depending on your personal financial structure and taxes. Okay, but talk to us about that. We'll walk you through that. But that way you get the benefits of real estate investing, because you got two options. It's either going to a black hole to Uncle Sam, right? Or you bring it into real estate and grow your family wealth and get all these benefits of tax advantages, cash flow, appreciation, write-offs, all these things, and own an asset that moves your family forward. Black hole, grow wealth. Pretty easy, as long as you understand it. Okay, so this is the $100,000 investment. Take a look at that. A couple case studies on this to kind of show you multifamily. So we currently have a deal that you can invest into in College Station, Texas, near Texas A&M. Great asset. We picked it up at an incredible value, purchased it at $13 million. Exit value projections right around 23. But this is how this thing's looking so far. We have cash on cash returns of 7.5%, IRR of 23, almost 24%. The LPs are getting about just under 19% IRR on that. It's currently an active deal you can invest into. Purchase thing right. I mean, originally went into escrow with other groups over 16 million. We waited. It fell out twice. We picked it up at 13.5 for 144 units, College Station, Texas. And this breaks down the cash flows. You can walk through these on the deck. I won't spend time going through them here. You can take a look at it all, okay? But LP profits coming out of this thing when we sell it, projected right around just under 6.4 million. Tax benefits, bonus depreciation, year one, $6 million. Pretty killer, pretty killer. So that is the multifamily deal, right? And the ones we're looking at are very similar to this, guys. I mean, you're looking to, but this deal was stressed, not foreclosed, nothing like that, but a stressed deal that we were able to pick up at a great basis, even in this market today. And we're going to carry that thing forward. So what's crazy about that deal is that it has a development component that isn't even caked into the financials, meaning we're entitling that lot right now, that land, for a mid-rise, 4 or 5 story, brand new multifamily building with retail on the first floor. And that's due to some recent ordinance changes within that College Station area that's allowing that, and they really want it. So totally not in the financials. The LPs are going to get the benefits of it. They just don't know it yet, but it's not baked into the financials. It's just, that's all just hope and pray home run stuff when it hits, but we're in that process right now. So very, very cool. Here's some example of all the deals we've done, so you can take a look at that on the deck for you. And then let's take a look at the flips to give you kind of an example of, flips and what our typical flip looks like in San Diego, California. It's a very specific flip model that works, okay, under price points. So here's an example flip, 21 days on the market. But let's walk through this. This was 980 Orma Drive this was Point Loma. Purchased this thing, we bought this thing, we got the acquisition of 1.6. Yep, bought this thing for 1.6. We had financing and holding costs, the reno costs, all the sales and closing costs, all in that. Net profits of just under $300,000, right? Sold it for 2.8, bought it for 1.68. Net profits of 283 grand. You can walk through this. And this was a couple years ago in 2024. So great little property. This is our formula. And you can kind of break down how we look for things, the price points to acquisition, kind of buying somewhere in that 1.2 to 1.8 range, right? Selling in the 2.2 to 2.8 range, right? And then you got about, call it $400,000 to $600,000 in total cost in there between reno and everything else. And that's the model, and it's worked great. And we typically are staying west of Highway 5 in these pockets where things move pretty quickly, plenty of buyers, even cash buyers and all that in there. And we can get that, call it the mid-range luxury, right? It's not the uber luxury that's going to sit there on the market forever. It's the mid-range luxury that people can still finance these things. They can get it. Plenty of money coming into these San Diego regions for this type of stuff. And these things are operating well. What's also unique about our model is our designer. It's kind of our secret sauce. The guys that we partnered and worked with, our designer is incredible, you guys. And just to give you perspective, like when we acquire a property, we get an entire design package for about 14 grand that shows everything and breaks down the entire house all the way from soup to staging on this thing. And they always put in a very unique feature into the home that when the wife walks in these things, sold, like done. It's always a unique feature. Maybe it's a unique courtyard. Maybe it's how we set up the kitchen and we broke things together, because it's always kitchens and bathrooms, right? Kitchens, bathrooms, master bedrooms, and baths, right? Kitchens, master bedrooms, and baths. Those sell the homes. And then you can put that together with a unique feature of the home specific. Maybe it's a great outdoor patio that's set up very tranquil with water feature and all these little things. Maybe it's a great little courtyard. Maybe it's the design concepts, how we made it super intimate inside. Just the way these things are set up, guys, that's what sells them. Wife walks in the home, done. It's done. And then the husband's forced to buy it or one way or the other. But it's because of the design. That's the secret sauce. That's what separates our properties from many others. where you could walk into two flips side by side. You walk into ours and another one, and you'll be like, wow. You notice the quality, the attention to the detail. And this is what people pay attention to at this price point, which is that kind of middle range luxury where people come in and they will pay, right? They will pay a premium for greatness. They will, to a certain leverage point, to a certain point. The quality of craftsmanship and the uniqueness in the design elements of the flips is what makes them sell well and sell even in tougher markets, right? When you're competing against other flips, and you could walk into all these ones and they all feel the same and they all have the same finishes and all this other stuff. And then you walk into these, you will feel the difference. You will notice the difference immediately. And that's why ours stay on the market the least amount of time. They move the fastest and we make the most money. That's why this works. Okay. So you can take a look at some of these examples we put in the case studies here for you. So let's talk about the market. Let's move through that. Flip market in San Diego, going it through here all the way through 2024 to here where we're at today. Kind of looking through the inventory, putting sales, monthly supply and all that. Yes, the supply has ticked up, but the market's still moving. You need to stay under a certain threshold, ideally under the $3 million price point in SoCal, specifically San Diego, and you need to build a great product, right? People will pay for greatness. If you set it up right, and then you're competing with others in the marketplace, if you make unique features about these properties, they will sell, and they will sell fast, and they will sell for a premium. Right? When you compete and you do it well. So this is going over the flips. You can take a look at this on the deck. Looking at target markets that we're in, you can see the highlighted states, everything from the West Coast. We're particular about California. Don't worry, we understand. But there's particulars as to why that works in SoCal, Arizona, Nevada, Texas, Oklahoma, all the way up through the Midwest. We'll even consider the upper Midwest. We're not in there currently, but I like Indiana. I like Ohio. I love Tennessee and Oklahoma. Tennessee and Kentucky and all of that. So we're there. We're looking at them. Okay. You can see all the highlighted ones that we focus on. Cap rate and loan holders, right? Multifamily's distress rates earn the largest monthly increase with 80 basis points. So you're seeing the stress in the marketplace from syndicators who bought these deals and can't get out of them. And so they're forced to make some pretty tough decisions. Either we move on and get out of this thing and at least avoid a foreclosure, but most of our equity's gone, or we're going to get wiped out. That's one of the two. But that allows us to go in and acquire something at a stressed rate, new basis based on today's market environment, put on good debt, right? And take on, you're only putting 65% leverage on these things. And then you're going to operate them better and you're going to ride this thing up to get to the upside in these deals. Guys, we can find the deals. We just need to make sure that we have the liquid capital gold ready to go to take advantage of them quickly. And that's where you come in. That's where we come in to take these things down. You can take a look at this in the markets. All the stress rates, we follow things very, very closely on credit IQ and looking at all the loan problems that are out there on multifamily and where to target those things. And I'm getting deals across my desk all the time. We're seeing them. A lot of them in Texas right now, some of them in Florida. You're seeing a few in the upper Midwest, but not as many. That market's a little more stable. And then the Southwest, anywhere through Nevada and Arizona. But those markets are coming back a little bit better because they're higher growth markets with not as much new supply. But Texas right now and through that kind of upper Midwest, they're getting hammered because of the supply issues. And it's a short-term problem. The market's coming back and there's a lot of growth in Texas. There's a lot of people moving to Texas, a lot of jobs in Texas. But they overbuilt that thing in the short term. And so, but now's the time, right? When blood's in the street, you go. And then you ride that wave right back up. So really between 2026, stabilization year, 2027, 2028 is the roar. And you watch all the way through it. The key is putting lower leverage, 65% debt-ish right in there. Good cash flows, good fundamentals, and come in and operate that thing much better at a new basis. And that's where these deals are going to make sense. So how to invest? Pretty simple. Scan this QR code. You'll have the deck. You can also go through and scan that. Set up a phone call with us. Happy to chat with you about this. See ultimately where your interest is at, right? And what types of assets you want to invest in. Maybe you want to go straight multifamily. Cool, we got that for you. Maybe you want to diversify and get the higher returns amongst the allocation that we do, 25-75. 75% of the money goes into multifamily, 25% goes into the flip model. So that's an option for you. You can pick and choose where you go. And then have the redemption rights. That's the best part about it, is having access to be diversified, and because a lot of people's hindrance that I've heard in speaking with investors, including myself, and going into a fund like this is, number one, money tied up too long. How do I get it out? I don't really want a blind pool fund. I want to kind of know, or at least be able to see what the deals, where's the money going? Because I typically do deal by deal. Well, you kind of get the best of both benefits here. You're going to get to put it into the deal you want, or multiples, and see where it's going. And then diversify across different asset classes, meaning the flips in kind of the ADU game in Southern California, San Diego. That's very, very unique to SoCal because of the laws in place that really help with that, with the ADU development and flips. And then going into multifamily, but setting it up right. So scan this QR code, reach out to me. Love to chat with you about this $50,000 minimum investment. And you can read through the details and stuff on it, but would love to get you involved. Now's the time. Now is the time. So let's go. Let's make this happen, okay? You can see if you're an accredited investor, this is a 506C offering. 506C offering allows us to publicly market it, but you need to be an accredited investor. And so you'll see this on your screen that's going to dictate whether you fit into that. You'll fill out a questionnaire for us so we can at least check that box to ensure that you're meeting it. And quite honestly, number 5 down there at the bottom, read that carefully, because a lot of people, they'll say, oh, I'm not accredited. You'd be surprised. You'd be surprised. A lot of people are accredited and they don't even realize they're accredited. So take time to look at this, but reach out to us. We'll double check everything if you want to get involved with us. So here's the team. Myself and Christopher Pohle are the main heads behind it. We have some strategic partners as well that we're working with on the flips, and then some other folks behind the scenes. We also have our accounting and legal team for all the syndications, our construction and management team on site, and we have our property managers all over the country for the multifamily. So we only work typically with the largest ones, the best ones that we have great relationships with. So regarding Chris and I always say that people invest with people, right? The deals can be great, but if you don't trust me and you don't trust Chris and you don't trust our strategic partnership team that's not even shown here, it doesn't matter how good the deals are, right? If I don't like you and I don't trust you, I'm not giving you any money. And I've always been that way too personally. And so a little bit of background on myself. So born and raised in San Diego, California, grew up son of a builder developer, my dad, Jim Brennan. I learned a lot from my grandmother, God bless her soul. She was 91, still driving around in a S10 Chevy truck, collecting rent from her tenants in South Bay, San Diego. And then my dad was really that zero to hero journey guy for us. He took it from my grandmother, did Vietnam, came back and got into real estate sales, hated it, started doing little subdivisions of homes, building little single family homes, and then got bigger and bigger and bigger. And went through 4 different market cycles and became massive. I mean, built, close to 9,000 units and properties throughout the west of the United States over his 40-year career. I mean, it is astonishing when I go back and I look at the resume on it. But I learned a lot from him. We didn't grow up rich initially. Little 3-bedroom, 2-bath, home on Dory Road in Bonita, California. Military family and background. My dad was Army. My grandfather was Navy. My current business partner, Chris Pohle, who's in this, former Marine. So that discipline and stuff behind that is critical. I think it's important from a foundational standpoint, integrity, all these things you look at with people. That's all really important. And that's the military background. But then with my dad, I watched him go zero to hero and go from just normal investing to like big time. Right? And big time money all over the Western United States, building big apartment complexes, 200-300 unit deals, ground up construction, owning them, selling them too. He never held a lot of the stuff. So looking back at that, I wanted to do that, especially after the financial crisis and watching what happened. I said to myself, when I build this thing back, I'm going to make sure that we build it on good fundamentals. And the key thing to holding power, staying power in real estate is do not over leverage, right? Do not over leverage, and cash flow is king. Right, you got to have cash flow from day one, and do not over leverage, because that's the only ways you get caught. Otherwise, you have staying power. The markets always come back. They always come back. It's not a matter of them not coming back. Okay, it's just a matter of how long it's going to take. So you can read about our profiles here. Christopher Pohle, a former Marine, owns tech companies now. He's on the board of directors. I run the day-to-day operations, but he's behind the scenes making connections, people, capital. Brilliant guy. And that's why we'd partnered for over 15 years. We met in grad school, 2005. In the back of a grad school classroom in University of San Diego. I went to Pepperdine University for undergrad, business and finance, went to graduate school at University of San Diego, USD, for business as my master's degree, but also had a double master's degree in real estate development. Went through the Burnham Moore's MSRE School of Real Estate there. Met a lot of people, incredible. And, look, book smarts are great, but street smarts are better. And that's what I learned on the ground from a lot of really incredible people. Mentors in my space. I wanted to finish off on this because people invest in people. And if you're considering, hey, who are these guys? Do I want to invest with them? Let me give you two quick stories because I think this is important to put in place my mindset around investing. Let's take a deal, our 121 unit deal in San Antonio, Texas. We bought the deal, closed in December 2021. By March of 2022, as we all know, the interest rates began to go berserk. I began to watch it happen. And it was stunning, right? It was stunning. Let me unshare this screen so I can kind of walk through this with you guys. Stop sharing here. Stop sharing. There we go. Cool. There we go. So bought this deal, bridge debt, business plan's going great. We're turning the units, hitting the rents, moving forward. And of course, our interest reserve, right? It started at 4.2% interest, went from there to 9.5% interest, all within 9 months. 11 interest rate hikes, as we all know, in 9 months. I mean, we knew it was going up. We weren't stupid, but not like that. So I'm watching this happen and we're just burning through interest reserve. And I said, we need to get this thing done faster because we have $5-6 million of investor money, including ours. We invest in all our own deals in this thing. And I saw it going down. And I called our partners and I said, guys, do you see what I see? And they said, yep. And I said, we need to get this reno done like yesterday. We need to get this thing leased up and get into fixed rate debt like yesterday. But these guys aren't moving fast enough on site. If we don't do something drastic, we're going to run out of money. And then we're going to be, you know what, creek. And they said, yep, I agree. What are you going to do about it? They leaned on me. I said, well, I'm going to move out there. I'm going to move out to the property. And I ended up leaving my family for a few months, moved out to the property on site in a model unit because I had the renovation construction guys saying, we can't move any faster and can't do this and can't do that. I said, guys, I'm a licensed general contractor. I'm going to show you and I'm going to work with you. We're going to get it done because we have to. We don't have a choice. We have 5-6 million reasons why we have to get this done. And I moved out there, moved into the model unit, worked with the team every single day, getting units done, rented, turnover, leased up. We got that thing to 98% occupied, delinquency down to 2%, everything rocking and rolling, humming beautifully. Got it into Fannie Mae. Our loan brokers with Walker Dunlap at the time saw that and they were like, holy crap, Justin, we have never seen that before. We have never seen one of our operators, syndicators, move out into the property to get it done and get it across the finish line. And we got into Fannie Mae fixed rate debt at 5.4% leveraged at 62% LTV 7 days before the 10-year treasury went through the roof. Yeah, baby. That's what we had to do. And even now, the thing, now it's not a debt problem. We don't have a bad debt problem there. We have an operational market problem because Texas oversupplied. So we're fighting through that battle of delinquency, right? Tenant-based demographics have changed. The vacancies changed as well. So we're fighting through that thing. And most of the market right now is 15% vacant. You got 80% occupancies and 85% occupancies. But the only way we'd be able to fight through that battle and still be fighting right now is low leverage, fixed rate debt, cash flow. Otherwise we'd be done. Keys would go back to the bank. So that's the type of things that I think are important. It's not when times are good. Anybody can operate. Anybody can sit there with a smiley face on a Zoom call when times are good. It's when things get hairy, things get gnarly. And what are you going to do about it? Are people going to quiver and tuck tail and run? Are they going to step up to the plate, put where their mouth or money where their mouth is at and leverage in and lean in? That's what we did. So that was that example. Finish off on this one. Another deal, 2022, March, right before the interest rates go crazy. We go into escrow on a 200 unit deal in Texas, $32 million total deal, including renovations and everything. Deal, awesome deal, great property, great location. Everything looks great. I knew interest rates were going to go up. Once again, not dumb, but reasonably. And this thing kept getting worse and worse and worse and worse up until the point that we had done 3 extensions. We were almost 5 months in escrow at this point. And it's like putting a square peg in a round hole. Couldn't do it. But, we were having tough moments with this because we had $1,000 hard. That included our deposit monies plus due diligence money. We're in this thing. We're married. Now, keep in mind, we, the syndicator, operator, this was all of our money. We do not risk investor money until we're getting ready to close. So I'm sweating, right? This is a big moment. And I'd never been in this moment before, but our partners had been. Been in tough markets before. So that this wasn't their first rodeo. And I called them up one morning and I finally said, I said, listen, guys, I can't with a good conscience feed this thing into a round hole and we got a square peg. I can't do it. Knowing what I know, I can't risk $12 million of investor money. I'll never live with it because there's a 50-50 shot. This thing's going back to the bank. 50-50 shot. And I can't with a good conscience do this. So we walked. We walked from the deal and left $800,000 of our own money on the table. And the investor saw that. They saw how we took it in the shorts and they respected it. And that is what gave them these guys are cowboys. These guys will take it. it shows you how doing the right thing pays off, because 90 days later, an off-market deal comes available in San Diego, California. Like, not a typical place, but we're from that market. Screaming deal, completely off market. And I knew it. And I saw this thing. I'm like, oh my gosh, we can pick it up for that. And these rents are like 100% under market. Absolute home run. And because of the way we handled that deal in Texas, all of that money came out of Texas into that deal in San Diego, and everybody's going to make a grip of money. So it goes to show you how doing the right thing matters, not just doing things right, because doing things right, maybe close on the deal, but that's short-lived. Because I can guarantee you now, looking back at that thing, keys would have been back to the bank 24 months later. Knowing what I've seen now, right? Hindsight, but best, hardest business decision I have ever made so far. Point being behind all this, you hear the cliche, we treat your money like our money. Really do, though. And the proof is in the pudding around it. I will fight, and I'll get up and I'll keep fighting. When I'm done fighting, I'll get up again and I'll keep fighting. And I'll keep punching and I'll keep kicking until I'm dead, right? The only way you lose is if you quit. It's the only way of certainty of loss is if you quit. And I will not quit, so that I can assure you. So I hope this helps. We're doing it the right way. Raising money. I always say, as long as you got horsepower behind you, I can find the deals. We can find the deals, guys. We need to make sure we have the horsepower, and you can be a part of that. And I would love for you to be a part of that. And invest in us, right? Invest in us. The deals are the deals. We'll find the right deals. I've always said you invest in people. I do. When we invest in other deals and other syndicators and other operators, we're investing in the people. I want to know you. And I want to know you're going to put your you-know-what on the table and fight, because that is the difference. As my partners would say, Justin, are you ready to put your big boy pants on? Are you ready to put your big boy pants on? Because this is going to be the separator between people that make it and people that quiver and run, and we will not run. So hope this helped. About a 35-minute video now. We'll cut it down. Great little webinar for you. Thanks for spending the time with us, and let's go.